guys, it's Chad Larson. Welcome back to MLD Wealth Money Matters. As you know, I'm your host, and today, we're going to go deep into one of the fastest growing and perhaps most misunderstood corners of alternative investing, private equity secondaries. So the title of this podcast is Secondaries Unlocked Inside Coller Capital with Dan Cohen. So joining me is Dan with Coller Capital, a global leader and true pioneer in the asset class. A little bit about Coller Capital. They're one of the world's leading investors in the secondary market for private assets, and is widely acknowledged as an innovator in secondaries. So why Coller, and why I have the pleasure of having Dan and join us here today. They're an aligned investor. They're the largest investor in every single one of their 9 flagship funds, along with 2 additional credit funds. It's an enduring platform that's been around since almost the genesis or creation of the sub-asset class, if that's what we want to call it, and are true specialists and experts within secondaries. So they have over 9 flagship funds, over $40 billion of AUM. They've been doing this for 35 years, have an incredible breadth and depth with over 80 investment professionals, over 300 employees across, Dan, I think 10 offices globally. Is that about right?
11 now, but yeah, close enough.
11 now, yeah. So, but listen, they're a pioneer and an innovator, and we do have an allocation to Coller Capital in our, specific for private clients of MLD Wealth. As you all know, we launched the Alternative Private Income Portfolio, which is a one-to-many strategy that we launched in partnership with Obsido. And the allocation that we made recently to Coller Capital is something that we continue to expand upon, and as well for select high net worth and ultra high net worth clients are giving access to this style or niche of an investment. So we thought we'd have Dan on today to really not so much demystify, because I think in reality, I think the percentage of people that actually know what a secondary is quite low. So we wanted to have Dan on here today. So as I mentioned, Coller's one of the world's leading investors in the secondary market for private assets. They opened their doors in 1990 and have really helped industrialize the secondaries industry into the mainstream asset class it is today. So over the years, they've been responsible for many of the innovations that have shaped the industry, and this pioneering spirit continues to shape the culture of their business. They completed their first GP-led investment in 1996, and since then have invested billions of dollars over hundreds of transactions. So, with that, we kind of wanted to go through this in segments. So I introduced Dan and Coller. So Dan, again, welcome. If you could tell us a little bit, more about, for those less familiar, about Coller. I know I did a pretty decent intro, but how would you describe your firm's identity in the market?
Yeah, I think, and thank you for having me on this, Chad. It's a pleasure working with you. So I think you did a good job sort of articulating who Coller is. We are a global independent secondaries manager. We're based in London, although we do have 11 offices globally today, including Canada. The firm was started in 1990 by Jeremy Coller, who remains the CIO today and managing partner. And the firm is regarded as a pioneer of secondaries. Because before Coller's inception, secondaries was very much a cottage industry. We'll chat about this later, but there were less than $1 billion of transaction volume happening at the time, and obviously the industry has grown and Coller's grown with it. But we really pride ourselves on being independent and only investing in secondaries. So today our focus in that arena is private equity and private credit investing, again, only with a secondaries lens. And I mean, you said it at the outset, we're managing $40 billion today across both asset classes.
Well, let's break that down. What exactly is a secondary investment in private equity? How do I explain this, with watercolors, with a crayon, and we'll dive into some of the deeper details of it. But what is a secondary for our listeners?
Yeah, you know what? It's a question that we get often. At its core, and this applies to equity or credit, a secondary investment is an investment where an original buyer, or in an alternative context, a primary investor in a closed-end fund, is selling its investment to a new buyer. And so I often like to draw parallels to more familiar markets like the stock market or the housing market, where the first shareholder or the first homeowner would be similar to a primary investor, but then all subsequent trades and transfers are they're technically secondary trades. And
Fair.
so the same concept applies to private equity and private credit, where secondary investors like Coller were acquiring private equity and private credit assets from existing owners, whether it's the LP, an LP's interest in a fund, or from the GP that controls the asset. But it's happening at a point in time that's after the initial investment is made by the fund that holds these assets.
That's really interesting. That I guess everything post an IPO is a secondary, so you're effectively creating a market. Within that, I kind of want to jump into is the phenomenon. I don't want to call it a phenomenon because I don't think this is a fad, but we've seen, and I've spoken about this on our podcast before. Why private equity or why the companies are staying private a lot longer. Is the total addressable market of secondaries larger because companies are staying private for much longer, past the investment duration of many of these funds or people's need for liquidity?
I think there's a lot of things that are contributing to the growth in the secondary market. So one of them is as the primary markets of these asset classes, so think private equity, private credit grow, the transaction volume and the turnover of those assets among LPs before the expiry of the term of these funds will continue to grow. Like there's sort of a correlation between the growth in private equity and private credit primary and then the growth of secondaries. But if you sort of double click on that, what's happening is you have a convergence of themes that are also contributing to the increase in the use of secondaries. So a lack of M&A activity, which is widely reported, and a lack of IPO activity, which is also widely reported, coupled with fluctuations in cost of capital, that has contributed to private equity funds having less distributions to LPs, which then puts pressure on LPs to need liquidity and seek that through the secondary market. Likewise, it puts pressure on GPs where they don't have the same exit valves that they can turn to for their portfolio companies to turn to the secondary market through GP-led transactions or continuation vehicles to be able to get liquidity within their portfolios, continue to hold those star assets, and then provide some liquidity to their LPs.
Would you see, and this isn't meant to, flick private equity in the nose right now, but I always, I have these arguments. So we do a lot of work in private credit. For example, is endowments and institutions understand IRR. Typically, clients, they understand total return, and a lot of these managers have obviously a management fee and a performance carry. Is duration and length of time that they own it past a certain point where it starts to the MOIC will remain, the multiple invested capital will remain, but the IRR starts to flatten out based on the duration if there's no liquidity in the portfolio. Do you find that comes into play with managers looking to offload GPs?
I think so. Yeah, in the GP-led context, I think that perhaps that could be at play in Coller's universe of what we are looking to do in a GP-led context. It's less that, and it's more GP owns a star asset. They have a closed-end fund that has a fixed life to it,
Hmm?
and we want to be able to continue to own that star asset beyond the life of or the term of this closed-end fund. And so the only way they're going to be able to do that is to be able to move that asset into another type of fund,
Yep.
like a continuation vehicle, and find someone like us to help them do that transaction and provide liquidity to any investors that do not want to stay in on that asset.
Do you
And
find a
so,
lot of time that your GPs are co-investing into the continuation vehicles and it's just providing liquidity for LPs that need money?
yes, I mean, in
Yeah.
our case, one of the prerequisites is that they're going to not just contribute, but they're going to stay firmly entrenched
Oh,
in the
amazing.
deal and
So you're
be
not just
cash.
offloading the stuff they
No, no,
don't
no.
want. Because I
Well, I
think
mean, perhaps, but not
yeah.
in not in the deals we're doing.
Fair enough. So it's a great, and I had this note written down, and I like colloquialisms or taglines. So is a way secondaries, is it a way that lets investors jump into the race after the race has really already started?
Absolutely. I mean, we talk about that all the time when we're trying to paint a picture on what we do. We view ourselves as we're evaluating and investing halfway through the horse race. So you're past the start point. You're able to look inside these portfolios and inside these businesses and take a view on how they're doing, where they're going to exit, what are the predicted cash flows over time, and then make an assessment based on that and come up with a price that you're willing to pay for the portfolio based on how you view or how we view the underlying assets are performing and will perform over time. And
And
that,
so,
yeah, go
yeah, and
ahead.
so when you buy a block of, when you buy a portfolio, yeah, do those typically come at discounts to, what would be, I don't want to say fair market value, but like mark to market of what industry consensus would be?
Yes. So generally speaking, whether you're doing a private equity or a private credit transaction, and then within private equity, whether you're doing a GP-led deal or an LP-led deal, there is likely to be a discount attributed to the purchase price, which will be based on the NAV of the portfolio or the assets at that time. The discount, it's not a fixed price,
Sure.
and it's going to iterate over time depending on market dynamics and needs, like the actual liquidity needs of the person that's putting the deal together, whether it's the whether it's the LP or the GP.
Yeah.
But there will generally be a discount to NAV, and then that discount, it could be high single digits, low teens for a GP led. It could be upwards of 20% for an LP led in the private equity context.
Yeah. The golden rule, he who has the cash makes the rules, right?
There you go.
All right, that's a great segment. Kind of the next segment is and I think you maybe touched on this, so we maybe will glaze through this one pretty fast. I was going to say, so why do investors sell, to callers and other people in secondaries? That recently in the media got some attention, and I had some feedback on it. Is like Harvard and Yale were in the media recently. Like, why are people when someone's selling something, you generally don't want to be a buyer for it, but why are some products coming or portfolios come to market? Why is that very common for you guys?
Yeah, so just to start with the tail end of your question regarding the endowments that came into the market this year, and it was widely reported that they were looking to sell some of their private equity portfolios in the secondary market. To be clear, yes, it was widely reported, and so it's generated a lot of buzz and attention. But this is a regular cadence and occurrence that we see as secondary managers in the market every year, where you'll have large institutional LPs or allocators that are looking to use the secondary market and partner with folks like Coller as a strategic portfolio management tool. So it's not new to us. We aren't surprised by it. Of course, it's getting a lot of attention in light of different geopolitical factors, but it's by no means an anomaly. To answer the first part of your question, so there's many reasons why someone, and I say someone because it could be an LP or it could be a GP, would leverage us and the secondary market. And the reasons are dynamic and they're going to evolve over time. But the key reasons that generally don't change are number one, first and foremost, provide early liquidity, right? These are closed-end funds. They have a term. They're generally, depending on whether it's equity or credit, 7 to 13 years with extensions. And so things happen, and allocators will need early liquidity, and the only way they're going to get it is through the secondary market.
Okay. That makes
This
sense. And so yeah,
yeah,
you touched on a lot of those. We had the
yeah.
denominator effect, so PE's grown faster than expected relative to public markets, and in an IPO market that's been widely reported and a little bit sticky. Doesn't mean the underlying companies, but perhaps the capital markets window isn't open for liquidity in the traditional IPO market.
No,
Institutional.
that's exactly what it is, right? And it could also just be something as simple as just a change in strategy or business model, where the allocator needs to shift. And the way they're going to do that is through the secondary market for their private assets.
So yeah, okay. So institutions wanting to rebalance and free up capital, and then strategy shifts. Okay, yeah, that's all the 3 points. So it's not a negative signal on private equity, but just smart liquidity management. Would you agree?
Correct.
Okay. Yeah. So we touched on a lot of that through kind of the second segment. There, I have to wave my hands so my lights turn on. Talk about a sedentary lifestyle sitting at a desk. It's segment four, growth and evolution of the secondaries market. So how has this market evolved, and how much room is left to run? We've kind of gone through, like within my private portfolios, private credit is a dominant theme right now. Your secondaries at private equity market makes up a sleeve within, one of the other food groups. We've got private credit, private equity, hedge funds, real assets, infrastructure, real estate. So you guys are, part of the toolkit, so to speak. But we've kind of gone through this gilded age of private credit, which the media loves to report on. Where so much capital flow. We're seeing, less competitive, more competitive, or more competition, more capital coming into competing against deals. And so there's only two things that can happen that we've seen in private credit is, sometimes, covenants are becoming weaker, coverages are becoming, tighter, et cetera. But where do you see, how much room is left to run, and where do you see that?
So, so first of all, just to touch on kind of how you opened the question, when Coller was founded in 1990, there was less than $1 billion of transaction volume in
Wow.
secondaries.
Wow.
In 2023, it was 130. In 2024, I believe it was 165 billion. And there was over 100 billion of transaction volume in the first half of this year. And we're on pace for what, folks are assuming could be 185 or more billion of transaction volume. So the market has evolved significantly, if you think about that, over a 35-year period. The reality is, and I touched on this in an earlier question, secondaries, whether it's equity, credit, or any other asset class, it will largely follow the growth in the primary fund business, right? And so
Sure.
we've seen tremendous growth in private equity, particularly private credit, and so the secondary market is going to follow and be directly sort of correlated to the increased deal flow and opportunity that comes from the primary market. But as the secondary market continues to evolve in terms of size and scale, you're also going to see it evolve in terms of different asset classes. And so credit is one where if you look at the difference between equity and credit, equity has many more players entrenched, and they've been doing it alongside Coller for decades, right? Whereas in credit, Coller started investing in credit secondaries in the early 2000s. So, we've been doing it for a few decades, but that's still very early innings for an asset class that is very much nascent. And in equity, it's a buyer's market still. If you look at opportunity set versus total dry powder raised by the secondary players, in
Yeah.
credit, it's an even wider opportunity set, given the lack of capital available in a very large primary credit business.
Yeah, fair enough. Yeah, that market's exploded and there's no one, there to pick up the pieces, so to speak, and carry the ball forward. So within the size of the industry today, or the market of transaction volume, you guys are a dominant player. Is that fair to say?
Yeah.
So it's a good and bad thing. And so one, I imagine you guys are first call on any transaction of scale. Would that be pretty accurate?
I think in general, there's only a handful of large scale platforms that focus on secondaries. And then there will be
Niche
iterations.
players. Yeah.
I mean, and maybe it's where you're going with the question. We tend to try to focus on corners of the market that are not necessarily part of the sort of broadly syndicated auction market. Of course, we're going to look at all those deals and get those phone calls, but like any other platform investing in private alts, you're going to try to find proprietary deal flow wherever you can. And so we're no different there, and it's something that we pride ourselves on.
Okay. That's great. Next segment was going to be, and I'll tee you up a little bit, because I really want to hammer down these points, but what differentiates the secondary managers? We talked to, if you could talk to scale, diversification, and pricing discipline, that would be helpful because as more capital is coming to this space, what would separate a firm like Coller from the rest?
So I'll key in on those 2 points that you mentioned, but coming at it from a slightly different lens. So I think about three core differentiators among managers and secondaries. So the first is where they are in the continuum of the stage of investment, where they're accessing these, and I'll come back to each of these points. But the first is the stage of the investment where the secondary player fits. The second is the size of the funds the secondary manager manages, and that will indicate how big of a check size and what types of transactions they're looking to do. And the third is the type of secondary investment. So if I just double click on those 3 points, and there's many others, but these are, in my view, the three core ones. Stage of investment. So some secondary managers invest in assets that are at a later stage of the cycle. So if you think of a closed-end primary fund with a 10-year term, these managers are buying these funds from LPs in years call it 8 through 10. Others, specifically Coller, we invest at a slightly earlier stage, closer
Okay.
to closer to when the investment period ends. So think, call it years 5 through 7, for example, 4 through
So there's
7.
almost like there's different styles within the style.
Absolutely.
Oh,
And the benefit in our view of investing slightly earlier than at the tail end of these
a little more
portfolios.
meat on the bone.
Exactly. There's more meat on the bone, or in other words, you're actually less concerned about what the discount will be, and you're more concerned about the NAV appreciation or NAV growth of the underlying assets, which,
You're actually
like,
betting on the company's growing, not just how bad you can beat up the buyer or the seller.
that's one way of putting it.
Uh,
Exactly. So,
Again, I told
um,
you crayons and watercolor.
no, that's okay. What you said makes a ton of sense, and it basically by being more focused on NAV growth and buying these assets at a slightly earlier stage,
Yeah,
yes, you have to underwrite them. You have to underwrite them bottom up and take a view on the
right.
company, but you'll also get a stronger predictability of outcome for the ultimate secondary investor, our clients.
Yeah,
So that's the first one. The second is size of fund, right? And here it's no different than any other asset class, but you'll see very large secondary funds, like think 20, 25, 30 billion. And then you'll see smaller funds that are, 1, 2, 3, 4, 5 billion. Coller, as an example, we screened over 200 billion of deal flow in 2023 against
wow.
what was around 160 or 130 billion of dry powder. And so there is enough deal flow to go around to all the secondary players. But as a manager and investor, you want to avoid winning deals just by paying the top price.
Yeah,
And so, in our view, having a fund size that sits sort of, we're scaled, but we're not the biggest or five biggest funds. Um, it allows us to lead and execute preferred opportunities without necessarily being part of a club or syndicate, but we're small enough to say no to almost everything that we see and be hyper selective. And that's Coller's view and our practice around sort of screening opportunities and how to size our investments. And then the third point, and apologies for more of a long-winded answer here, but it's a good question, is the type of secondary investment, right? So if you think of the private equity ecosystem of secondary managers, you have managers that focus on LP-led deals or continuation vehicles, and you have others that focus on GP-led deals or continuation vehicles, and others that focus on LP-led deals. Generally, they will potentially play on the margin in the other type of deal, but they're focused on one corner of the market.
okay.
And each have their merits within a portfolio of secondaries. And so LP-led deals will give you the diversification that secondary investors look for, whereas GP-led deals can generally provide higher concentration and higher returns. And so Coller actually takes a more balanced approach. We always have and continue to do so, where we are really opportunistic around accelerating and decelerating the pacing of our investments into each of these sort of types of deals, whether it's a GP-led or LP-led, based on the merits of the opportunity and also what's happening in the market. And that will then also dictate what the overall blended discount rate is that we're paying, because GP-leds will often have a tighter discount than LP-leds, as an
Yep,
example, just
yep.
like we've been speaking. And so when you look at Coller, there might be years where we do very few GP-leds and only focus on LP-leds, and then vice versa. And so you end up with a balanced portfolio between the two. But
That's
on a
on that
year-to-date,
vein. Yeah, that makes sense. So like let's just pretend someone, isn't gonna buy into your fund. The what's the concentration like I'm buying, I'm signing an OM subscription agreement and investing capital into callers. Um, how many portfolio companies do I own? What is my max exposure on all the underlying investments? How diversified, are the vintages of these portfolios or like a current vintage? What does that look like?
yeah. So the way we view our strategy for private equity and also for credit, but just focusing on equity for a second, just based on your question, it's going to be hyper diversified. Like at scale, you're talking about what will be thousands of companies diversified across sector, vintage, very diversified across cost base of the underlying individual companies as a representation of NAV.
Sectors,
Um,
industries, geographies.
All of it, yeah. And so, I mean, we're obviously going to have a tilt towards the private equity market in general as to where
Sure.
that's diversified. So,
Yep.
if large private equity managers in their primary funds are focused on mainly North America, mainly financial services, healthcare services, business services, you'll see that bleed into our
Sure.
portfolios,
Sure.
just by definition of what
But
we're
you're not
ultimately.
buying you're not buying a portfolio that has six investments, six bets, and see how it does.
No, these are hyper diversified. Our funds are hyper diversified across underlying asset, and then therefore also across the different sort of key areas you'd look for diversification.
Okay, great. Kind of the next segment is obviously secondaries in a private wealth portfolio. I'll probably do a little bit of the talking first, and I imagine you'll agree. It's why you're on the call today, as a partner with MLD. So at MLD, we believe, secondaries belong at the core of a private wealth alternatives portfolio. And that view is really, meant to complement an overall portfolio from, looking, beta is what happens within the market. Alpha is those excess returns, but looking at non-correlated assets through periods of bifurcations in the market based on fear and greed and geopolitics and things that can move very fast against. A lot of times, a publicly traded company's stock moves based on a bad tweet, some sentiment, something by the Fed, something by this, but ultimately having the exposure to non-correlated or alternative assets, we have found both as an alpha driver of driving excess returns. I think it's something to say, like, for example, like we are, I guess it's August 1st, it's July 31st today, but how is your portfolio, performed, as of recently, aside from being a great tool to reduce beta volatility and to achieve broader diversification? What type of returns have you seen in this asset class?
Yeah, so generally speaking, the way we think about it, right, is the target net return, right? And you mentioned the key points like thanks to diversification, the discount capture or the discount that we're paying for these assets, there not being a J curve, and then the underlying, which is key for us, the underlying NAV growth or NAV appreciation of the underlying portfolios that we're underwriting, which we achieve based on the timing at which we make our deals. It contributes to a net median return that over 20 years has outperformed other alternative asset classes like buyout PE, venture, growth, real estate, and private credit. But it presents as an asset class, and I'm talking about secondaries and what we do, the lowest capital loss risk of any of these asset classes. So I'm just going to give you some numbers because you asked the question. Between 2003 and 2022, less than 2% of secondary funds did not return at least 100% of capital back to its investors. And
That's
that's significant.
significantly better than credit and for buyouts.
Correct. It beats both of those asset classes in that metric. And so, we often say the benefit you get as a secondaries investor, and this is whether you're a private wealth client or an institutional investor, is you alluded to it, you're betting on the race after the race has already started. And so we think about this as a nice asymmetric offering that other asset classes are not able to offer. And so that's how to think about our funds and where they sit within your sort of total portfolio allocation in terms of what we're looking to deliver as a strategy.
Amazing. So, we're almost kind of done here, and I really appreciate that. I know our listeners and private clients and people that kind of tune in to just to see what we're up to, and um, it's been a structural, I wouldn't say shift or a decision, is generally I kind of come on a monthly basis and parrot about what's going on within beta, what's going on within the marketplace and geopolitics and, how we're positioning, capital within the beta markets. But I thought it was really important as the industry is paying more attention and, the retail clients are starting to ask questions of their advisors of, hey, I'm hearing there's other things other than your conventional 60/40 portfolios. Those portfolios have not typically performed as to model for various reasons. Fiscal policy, monetary policy, interest rates, et cetera, et cetera. And I do believe, I think I'm probably within my own system, one of the first allocators across, my firm to make that, I don't want to say jump, and it's definitely not a leap, because, this investing, that we were going to get into, how do you access this type of investment? Um, it's not rocket scientists. So you guys have come into Canada and have a feeder fund that allows investors to invest in it. Obviously, all the small print and caveat emperor and buyer beware of all of things is to when looking at allocating to alternatives investing in general, aside from discussing your fund in particular, is making sure that you have professional advice. Obviously, liquidity is important. I know the fund is structured with monthly subscriptions and quarterly redemptions, and you've worked through the systems to make the fund RSP eligible, I believe, if that's correct. I just know, I continue to lead the industry and having, the time, care, and attention to form formidable partnerships with institutions like Collers has been additive to the results. I wanted to thank you, both for your time, but for I guess coming into the retail market and investing your time and expertise to both educate but be able to deliver product whereby for the right investor at the right time given their unique investment needs and liquidity parameters to be able to partner with such a global leader has been an absolute pleasure. So I just wanted, I guess, kind of, say that, hit all the high points. It's diversified by design. We're seeing strong risk-adjusted returns that have been strong to match. It's a structurally growing market, that's in the making with a partner like Coller that has a deep track record, is recognized as a pioneer in the space, that's still traditionally underallocated by private wealth, and that's changing fast. And I'm glad to be playing a role in that. And it's been an absolute masterclass. So thank you. And to our listeners, if you're rethinking, private equity exposure, looking to build more resilient approaches, reach out to myself or anyone on our team. And you can quickly Google collarcapital.com or reach out to us directly at MLD Wealth to see how we're incorporating this strategy into our client portfolio. So Dan, again, thank you so much for today, and I look forward to years of partnership.
Same here, Chad. Thank you.